Call the meeting to order. Pursuant to Standing Order 108-2, today a study of the report of the Bank of Canada on monetary policy. We have with us the Governor of the Bank of Canada, Mr. Pelosi, and the Senior Deputy Governor, Ms. Wilkins. Welcome both, and the floor is yours. I understand you have an opening statement.
Well, thank you, Chair. Good afternoon, and good afternoon to committee members. Senior Deputy Governor Wilkins and I are happy to be before you today to discuss the bank's monetary policy report, which we published just last week. When we were last here in April, we were celebrating the fact that we had upgraded our economic forecast. That was following a long period of disappointment. And I'm pleased to tell you that many of the positive trends that we saw then have continued. Sources of economic growth have broadened across sectors and across regions, and the process of adjustment to the oil price shock is essentially complete. La Banque a relevé son taux directeur 2 fois depuis notre dernière.
The bank raised its policy interest rate twice since our last visit in July and September. We did this in the context of very strong economic growth over the first half of the year and solid progress in the labor market. Over the summer, we saw evidence of firming inflation and an economy that was rapidly closing its output gap. With these two rate increases, we have taken back the cuts we made in 2015, which were crucial in helping the economy adjust to the oil shock.
Averaged just over 4% at an annual rate. This reflected strong consumer spending, backed by rising employment and income, together with increased business investment and a jump in energy exports. We are now starting to see signs of a moderation in the second half, which we forecast in July. Growth in consumption and investment is expected to ease, and growth in housing is projected to slow further, in part because of the measures introduced by the Ontario government in April. All told, we forecast that the economy will expand by 3.1% this year, before slowing to 2.1% in 2018. This is still faster than the growth rate of potential. We estimate that the economy is now operating close to its capacity. Inflation should reach our 2% target in the second half of next year. That's a little later than we projected earlier because of the temporary impact of the stronger Canadian dollar this year. We're at a crucial spot in the economic cycle, and significant uncertainties are clouding the way forward. In our NPR, we identified the four most important sources of uncertainty, and I'll just touch on those now. The first source of uncertainty is inflation itself. There have been several conjectures about the apparent softness of inflation in Canada and in many other advanced economies. Some have argued that globalization is restraining inflation. This could be due to increased imports from lower-cost countries, for example, or to the effect of Canadian companies participating in global supply chains. Others point to the impact of digitalization on the economy. They suggest that digital technologies could lower barriers to entry in some sectors and lead to more competition. The rise of e-commerce may be changing price-setting behavior, and digital technologies could promote innovation and higher productivity, which could create disinflationary pressure. The second source of uncertainty is the degree of excess capacity in the economy. We note several signs that point to slack remaining in the labor market. For example, the participation rate of young workers is still below trend, and average hours worked are less than we would expect. With the economy now operating close to capacity, we expect to see investment by companies, together with job creation by new and existing firms, and rising productivity. This should serve to raise the economy's potential output, increasing the amount of non-inflationary growth that is possible. However, this process is highly uncertain and not at all mechanical, so we have built it into our projection in a conservative way. Le troisième enjeu est la faiblesse continue de la croissance des salaires.
The third issue is the continued softness in wage growth. While employment growth has been strong in Canada, wages have not kept pace. The slack in the labor market is certainly responsible, in part, for this effect. And there will be a lag between the time this slack is used up and when we see stronger wage growth. However, other factors, including globalization, may also be affecting wage dynamics.
Is the elevated level of household debt and how that might affect the sensitivity of the economy to higher interest rates. Bank staff have recalibrated our main economic model used for projections to capture key information about housing and debt. This work tells us that the economy is likely to respond to higher interest rates more than it did in the past. However, we will watch incoming economic data closely for evidence to support this idea. We'll also look to see how the household sector is responding to the new rules about mortgage underwriting. We also outlined several other risks in our MPR. Taken together, these give us a balanced outlook for inflation. We have not incorporated into our projection the risk of a significant shift toward more protectionist trade policies in the United States, given the range of potential outcomes and the uncertainty about timing. However, we acknowledge that uncertainty about future U.S. trade policy is having some impact on business confidence now, and investment spending as well, and this impact is reflected in our outlook. In this context, Governing Council judged that the current stance of monetary policy is appropriate. We agreed that the economy is likely to require less monetary stimulus over time, but will be cautious in making future adjustments to our policy rate. In particular, the bank will be guided by incoming data to assess the sensitivity of the economy to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation. Comme c'est un message très important, permettez-moi de le répéter.
Please allow me to repeat this in French. In this context, Governing Council judged that the current stance of monetary policy is appropriate. We agreed that the economy is likely to require less monetary stimulus over time, but we will be cautious in making future adjustments to our policy rate. In particular, the bank will be guided by incoming data to assess the sensitivity of the economy to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation.
Governor Wilkins and I would be happy to answer questions.
Thank you very much, Governor. Just for committee's information, we'll go till about 4:53 in this session. We're going to, because the committee business could take a little time, we're going to move it up in between the two, between the Governor of the Bank of Canada and the Parliamentary Budget Officer, and allocate 15 minutes there. We might not need it. But that should give us enough time. So starting then with Mr. Fergus for 7 minutes.
Merci beaucoup, Monsieur le Président.
Thank you very much, Mr. Chair. Thank you to the Governor and the Senior Deputy Governor. I'm very pleased to have you here for a second time before the Finance Committee, the second time since I've been a member of this committee. I'd like to congratulate you, first of all, for your work in guiding our economy in the area of monetary policy. My question has to do with the Consumer Price Index. It seems to me that it must be increasingly difficult for you to determine what basket of goods and services to study to determine the rate of inflation. Do you find that it's becoming increasingly complicated in this modern era compared to 15, 20 years ago? Fortunately, Statistics Canada takes care of that. But I will give the question to Ms. Wilkins, who could offer more details. I think Statistics Canada tries to choose a basket that's representative of goods and services consumed by Canadians. They try to weigh those goods and services in a dynamic way. It changes through time, not every day, but over time, based on their studies into consumer habits. So that's what Statistics Canada does. What we do is we try to explain the inflation process, which may very well be influenced by globalization, as well as the digital era. There are many more goods and services sold over the internet through e-commerce. There are many goods that are imported from countries that have a different rate of productivity, for instance, and that can have an impact on the inflation dynamic. And if you look at the Monetary Policy Report, we try to study that in depth. What we've seen is that there isn't a great deal of evidence that that really changes inflation in Canada. We can use our standard tools to explain it, but we keep an open mind because we never know. With more data and more experience, we might be able to identify more factors that come into play. I noticed that you use different types of baskets to calculate the consumer price index. So you weigh it in different ways. Does Canadian geography present difficulties because the basket in Eastern Canada might not be the same thing as in Toronto or Quebec, for instance? Yes, there are differences between different areas in the country. The main differences are the cost of housing in particular. What we see is that there's an inflation rate that varies between the major cities in the country. So it's a process of adjustment when there's migration between regions. When we see the cost of housing in Toronto, it goes up higher than in Calgary, for instance. They have different rates of inflation during a period of adjustment. And that reflects the real cost of living for people in those cities. Apart from that, for the most part, the indexes are the same. These are products that are consumed everywhere in the country. The differences are really housing and haircuts. Those are very localized products.
Mais les autres choses sont très échangeables.
Other things are pretty interchangeable. Do you have something to add? In some regions of the country, for instance in the north, the price dynamics could have an influence not only through supply and demand. It could also have to do with ad hoc changes in the cost of transportation. That could have an influence on the cost of all goods and services that have to be transported in. That's another example of why the inflation rate can be different in different areas of the country. The big question is regarding the very high rate of household debt. In the best possible scenario, how can we adjust the overnight rate to allow Canadians to lighten their debt load without at the same time creating rates that are too low that would encourage Canadians to go further into debt? It's a real question of balance. Our goal is to have a target for inflation. We don't have other tools to deal with the specific consequences. But we certainly take into account that factor. We look at the level of balance for inflation rates and for the interest rate. We've changed our models to take into account the fact that the debt level increases sensitivity in the economy to changes in the interest rate. So these are key issues that we are studying very closely, and that's why we are cautious in future adjustments.
Mr. Poilievre.
Thank you, Governor and Vice Governor. You identify in your report one of the risks that the highest in the developed world. You have publicly spoken about the dilemma that you face, that if you raise rates to discourage more borrowing, you may ultimately cause stress and strain on existing households, given the debt levels that they already have. How much of an interest rate increase could households absorb, given their existing levels of indebtedness?
Well, that's certainly the risk that you're discussing is one that's foremost in our minds, has been for quite some time. The elevated household debt not only poses this challenge about how interest rate adjustments occur, but of course it actually represents an ongoing vulnerability of the economy to other shocks, such as a new global recession out in the world. What would happen is that high levels of debt act as an amplifier to make the shock have a larger effect on the economy than it otherwise would. The sequence would be unemployment in Canada rises. For example, say there was a recession in the United States, unemployment would rise, and folks would have difficulty staying up with their mortgage payments, and that would give bigger cutbacks in spending than we otherwise would have. So we've always known that this would be if you like, a second order consequence of the primary objective, which is to get the economy back on track, get the economy back to our 2% inflation target, which means full employment, and that is the best contribution that monetary policy can make to ensuring that long-term these debts are sustainable and serviceable. The fact is that given the shocks that we've been through since 2007, you remember that in 2008, every country in the G20 cut interest rates very low and had a large fiscal expansion in order to offset the consequences of the global recession. I think this was an unqualified success. It certainly averted what I think we all by now would be calling the Second Great Depression. All the ingredients were present. And by 2010, it looked as though we had most of the bad news behind us. And so fiscal consolidation began to emerge as a priority in lots of countries. But as it turned out, the world delivered a bit of a slowdown that progressed, and interest rates needed to stay low longer. And so we have these consequences of higher debt. I just want to assure you that we take this fully into account. We'll be monitoring how households are reacting to those debt levels and interest rates. It's not a simple arithmetic calculation about what they can absorb. But the economy will moderate compared to the levels we've seen as this process unfolds.
You also identify in the section of your report on page 27, Risk to the Inflation Outlook, a larger impact of structural factors and prolonged excess supply of inflation. In that section, you also talk about the possibility that housing prices may drop. if that were to occur, the collateral against which household debt is secured would be reduced in value. How much risk does that pose to financial institutions or the insurers that back up those institutions?
Yes, it's exactly one of the scenarios that we consider carefully and have analyzed in some depth. So in our FSR, where most of this risk assessment takes place, that's the financial system review. So we consider risks which have large drops, much larger than one could normally anticipate, drops in housing prices, along with a recession. In other words, the recession causes the housing prices to fall. And so the economy has a double layer of shocks on it. And in scenarios even as grave as this, the financial system remains highly robust. It's true that collateral against which people have borrowed is reduced in value, but the financial system itself is very, very well provisioned against shocks of this sort. It's, of course, the new Basel Accord brings us into that zone. Canada has not had to adjust much to those new accords because we've always had a more robust provisioning system than in many other countries. So as a result, we're confident that the financial system itself is not a source of risk, but we consider these to be vulnerabilities, which are more likely, as I was describing a moment ago, to actually magnify the impact of shocks on the economy. Carolyn, did you want to add anything to this?
I would just add, aside from the fact that our banks are highly liquid, capitalized, and diversified, there have been other measures aside from interest rates. We've talked a lot about the role of interest rates, but there's a role for macroprudential policies as well. And so OSFI last fall and then most recently this fall has taken moves to improve the quality of debt that's out there by providing clarified guidelines to financial institutions that are lending to households about what kind of criteria they should put in place to make sure the household actually can withstand increases in interest rates. And here I'm talking about the new stress test that they put in. And what they did last fall was aimed at the insured space. And you could see in the data, you can see it now, that the share of households that are very highly indebted, so those are households that have a loan-to-income ratio of over 450%, that's fallen from about 18% to a little bit less than half of that now. What they did this fall most recently is looking at the insured space, because that's quite a growing area, and to apply very similar kinds of tests there. And it's too early to say what the effect's going to be on that. But it will, over time, improve the quality of debt so that it'll be more resilient to the shocks that the governor was talking about.
Go ahead, Mr. Poilievre. We'll go a little over the time because I think the answers require a fairly in-depth discussion. So go ahead. Your floor is yours.
Greatly appreciate it, Mr. Chair. With respect to, you mentioned, Madam Vice Governor, the macroprudential measures OSFI has instituted for mortgages that are of low loan-to-value, that is where down payments of greater than 20% are made. I met today with mortgage brokers and who made a point that was also made in the Globe Business Report earlier this week, that these measures, combined with the uninsured nature of higher down payment mortgages, in many cases lead to higher interest rates for those with bigger down payments than they would pay if they made smaller down payments, creating a strange, perverse incentive to put fewer dollars down on one's house. I think all of us would agree that we should be promoting bigger down payments because they're less risky to the system and to the borrower. Do you worry at all about some perverse incentives that may result from OSFI's recent proposals, recent regulations?
So What in fact is happening there is that if your down payment is less than 20%, the rules dictate that it must be insured. So a mortgage loan which is insured is of course lower risk to the financial institution. And so generally it's possible to have a lower rate of it's possible. It's not necessarily the case, but you would have a lower rate of interest on that. But the borrower must pay for the insurance. It's not zero cost, actually quite significant cost, which is rolled into the upfront value of their mortgage. And so they are paying for it in a different way. So those folks who have more than 20% down payment then go to an uninsured mortgage, and it's possible there will be a few tenths higher interest rate, but they're not paying for the insurance, which is a pretty big upfront cost. So I think in that sense, there's no perverse thing in the space around the decision, and I think it would be it's a stretch to create a case where you're actually better off in the first case.
Mr. Dussault.
Merci, Monsieur le Président.
Thank you, Mr. Chair. Thank you to the Governor and to the Senior Deputy Governor for being here. I wanted also to talk about household debt, but I think it's been covered. Perhaps we could talk about the relationship between two factors that may be related: the increase in wages, or as you said, wage stagnation, really, in Canada, and inflation. The link we can draw between the two. Canadians see the rate of inflation, the prices of products are going up, but salaries aren't increasing at the same rate. Do you see that as a long-term problem for the Canadian economy? Or do you have data on those two things and their interconnection? It's a very interesting question. We focus a lot on salaries and on wages. It's something we look at to see whether there's upward or downward pressure. And what we see with wages is that wage increases are rather weak, as you've said. And in box 2 of the NPR, we've tried to dig deeper. And what we've seen is that we could explain part of the weakness in wage growth by the drop in oil prices. So there were real effects for a sector that had high wages. It didn't affect the service sector as much, for example. In the energy sector, there was less wage growth, and that has continued. So if we combine that with data that there's excessive demand, or rather supply in the labor market, we can see why wage growth is weak. But we think that wages will continue to increase.
And so we should see an increase in these rates over time. But what you have to bear in mind is that the effect of inflation on goods and services that will occur. Well, thank you very much. There are certain policies, provincial ones perhaps, public ones, that might have an effect on salaries and wages in general. But the rate that you described certainly is one that is of interest. I turn my mind now to the government indebtedness. The government debt is increasing, and everybody has seen the economic statement. Do you think that this will pose a problem for Canada with the interest rates that will be rising and the effect that that will have on the debt itself? For the moment, we really do not have a budget for 2018. We only have what was mentioned by the minister, which will be added to the budget. So for us, it is not possible to analyze the net consequences for a budget before the budget is actually brought down. In fact, the Bank of Canada does not incorporate assumptions or hypotheses. It is only when the budget becomes law. Presently, it is a forecast. So as to the broader question, the ratio of debt in terms of the economy will continue to drop slightly, and it's a very low level compared to many other countries. It's not really an important question in that sense. Well, yes, I understand. It's the present forecasts of the Department of Finance. On another subject, I note that you mentioned, and I think it was in your report, that there was a trade deficit with respect to other countries, and I want to know if you have any other comments to make on this issue, on dangers or the impact on the Canadian economy, in that we expect there's going to be a trade surplus. So I want to know what the deficit, the impact of that trade deficit will be on in the long term on the economy. The trade balance is not really a very important variable in the sense that it has been described. It is structural, cyclical, and I would say that our balance has deteriorated given the drop in the price of oil. It has dropped by about 50%. That is the price of oil, about $60 billion per year of revenue coming into our country. But since that time, there has been an adjustment in other sectors. Exports have increased in other sectors, and even the volume of oil export has increased about by 25%. So these things are always fluid. They're in movement. The question here is that it is cyclical. It is not a permanent issue. It's not a weakness in the country. It doesn't reflect a weakness in the country for the moment. We have a strong economy. There is a lot of demand, and exports have just started to have a second level of growth. So I would just say that it's not a critical variable at the end of the day. It's something that is constantly changing. Thank you. And perhaps now I could move to something else. You talked about the cost of housing. Do you have any statistics or data on the percentage of Canadians that are with respect to housing in certain areas? That is to say, the portion of their income that they use for housing. It must vary from sector to sector in the country. The data that I have in mind relate more to regional distribution of debt, of indebtedness. About 80% of the debt held by Canadians of the same age is intended for a mortgage. So it is a mortgage indebtedness. It is a loan that can be taken. If you can use your house as equity, you can take out a loan using your house as equity. But with respect to the most indebted households, where they are in Canada, more than 450%, it is concentrated in areas where housing is very, very expensive, like Toronto or other areas. And you know, it was also the case in Alberta before, because housing was very costly in Alberta. So where you have an area where housing is very expensive, it's not surprising. But in those regions, the revenues can be also reflecting the high cost of living. But it's really concentrated in terms of housing in these high price areas.
Mr. Chair, thank you both for being here again. I have several of my questions are really from the fall economic statement, which I know is not your report, but the Bank of Canada is quoted in it in terms of the Bank of Canada's Business Outlook survey. So that's where some of my questions are coming from. But I want to talk specifically first here in regards to investments. And in the fall economic statement, it talks about the Bank of Canada's Business Outlook survey showing that there's a strong improvement in business investments in the intentions over the last year, and that the intentions remain in a solid positive territory, and that it's suggesting, that with capacity utilization rates of several industries currently close to their pre-recession peaks. I'm not saying that's what the bank said, but I'm assuming it's based on, they're saying it's based on your survey. So can you maybe speak to that, as well as the fact the statement in here is that the business investment improvements may prove to be more long-term and enduring in terms of continuation?
Yes, the situation, as I described earlier, is one in where we have the economy now, for the first time in many years, operating close to its potential. What one expects to see at this stage of the cycle then is firms that find themselves right at their full potential, and in some cases, in fact, some 75% of those surveyed in the manufacturing sector say that they're operating above their normal capacity level. So that would be overtime and that sort of thing. And so when we get into that stage, then companies generally begin to invest more, not just to replace equipment, but to actually expand their capacity. It could be an upgrade in technology, in which case they may be able to expand their capacity without adding more workers, but very often it's not the case. What happens is they actually add more workers too. This is a really important stage of the business cycle for us. We haven't been here for some time, but most business cycles, when you have that upturn, you reach that capacity stage, and the forecaster, ourselves included, have a trend line which is the economy's potential. And we're saying we're about at that trend line now. But what happens at this late stage is companies add more capacity and the trend line tilts up for a while and gives us more capacity and brings those folks who are, we say there's excess capacity in the labor market, that's where the economy has more room to grow. So it brings those people out of the the discouraged workers, or those who are working part-time can get a full-time job, and those kinds of things. So that adds to the economy's capacity. By our surveys, the economy is primed and ready for this phase, and we thought we saw the early signs of it in the first half of this year. So it's very reassuring to see, despite the concern which is expressed almost universally about the uncertainty of going forward about trade relations, trade arrangements. And so despite that layer of uncertainty, companies nevertheless are prepared to invest. So we take from that their intentions would be even higher were it not for that uncertainty.
Thank you. And actually, trade is exactly my next question, so that works out well in terms of obviously trade uncertainty and protectionist kind of attitudes, certainly in the U.S. and not only in the U.S., but in the U.S. certainly impacts Canada. So again, in the fall economic statement, this isn't your graph, it was provided by the OECD, and it talks about labor productivity growth. And Canada, certainly in terms of aging population and demographics, we have concerns, and we've talked about that here. But then I look at the United Kingdom, and I think, well, it's below 0.5%. I think it's probably 0.3. I don't know because it doesn't show all the numbers here. But isn't there a huge opportunity through CETA, and I get it with Brexit, with the UK specifically, but if there's a specific trade deal between Canada and the UK, I'm seeing their labor productivity growth being extreme. If I was in the UK, I'd be very concerned. Is there not, although there's uncertainty, is there not a level of huge opportunity and optimism given the fact that Canada's change between 2000 to 2007 and now is not as significant when you look at the UK as one example?
Right. Well, I would just say it's a more complex question than it sounds, because productivity is measured there, captures a lot of things in the economy. And so you could imagine if the UK was creating a lot of new jobs, but they happen to be, let's say, the average job that was being created was in the service sector at a lower productivity level than, say, in the financial sector, which is a high productivity sector, or in manufacturing, which is high productivity. And so the mix of jobs can affect those numbers quite significantly. I'm happy to say that Canada's labor productivity has picked up very strongly over the past year and a half to 2 years. And part of this is no doubt cyclical, because it is the economy shaking off the collapse in oil prices and moving on to growth in other sectors. But it is also probably related to this thing I was mentioning a moment ago to your earlier question, which is investment is picking up. And if a company hasn't been investing, say, for 5, 6, or 7 years, making their capital last, now every dollar they spend can have a big impact because it's new technology or just upgrading things. And in addition, we now know that some companies can invest without there really appearing to be any investment, which is they do something in the cloud, they buy a service in the cloud instead of investing in the equipment themselves. Investment looks like it hasn't gone up, but we get the impact as if they had invested. And so the data are going to be increasingly difficult to interpret, and StatsCan is all over this to help us understand it. But all to say that we are at an encouraging stage here in Canada.
Thank you. And I actually have a short one. In terms of, again, this is not your statement, but in the fall economic statement, it talks about interest rates, which we've talked about here. And one of the comments in the statement is that although interest rates are a risk, and we've talked about that here, but it says that most borrowers have fixed rate mortgages, and so that can be absorbed easily. I'm just curious though, does the Bank of Canada actually track and know and receive the information from all of the banks in terms of how many in 2017 signed a 5-year rate, how many in 2016 signed a rate, so you actually know how many people would be impacted in that given year of that given increase?
Yeah, the short answer is yes, we have fairly detailed data based on that, and in fact, we've incorporated that in our model. And so now, of course, there's always behavioral differences because some people choose to still keep variable. They don't always lock in. You have to think about the new home buyers who get hit immediately with changes in interest rates, but we're able to model that. And you're quite right, about 70% of mortgages are fixed rate.
Thank you.
Okay, thank you all. Mr. Albas.
Governor, Vice Governor, thank you for being here today and presenting to this committee. I'd like to start with the sections in your report that talk about growth prospects, particularly in the United States, and its impact here in Canada, both in the general economy as well as in monetary policy. Governor, in December, you had raised the specter of divergence, that you were prepared to use different tools at different times in order to differentiate and navigate the different effects on the Canadian economy vis-a-vis the United States. Obviously, you mentioned animal spirits in the United States right now, whether that be from increasing oil prices, and they're much more stable in their energy security, also in reference to possible tax reform. Right now, the American economy seems to be picking up. Do you feel that that interest rates right now, I guess you did the other day, pardon me, I should rephrase that. Do you feel that American interest rates are going to maintain or increase in the short to medium term?
Central banks never comment on one another's policies. It's just not done. But the Federal Reserve has telegraphed their intention over time to move interest rates higher, and they have these dots, which are essentially their forecast of the members of the committee, which suggests that interest rates would rise over time, but at an undetermined pace. We've discussed divergence in the past precisely because conditions changed so much in Canada relative to the United States. So in particular, when oil prices fell, that was, of course, a negative for Canada, but it was actually a positive for the United States. Even though they have an oil sector, net they are a net oil importer, whereas we're an exporter. And so in those conditions there, we actually had, of course, in 2015, the Bank of Canada cut rates twice while the Federal Reserve actually raised rates that year. So that's about as sharp a point of divergence as one can imagine, and that's why we have flexible exchange rates to deal with those kinds of shocks. So moving forward, what I would say that is, roughly speaking, Canada has just now gotten to the stage where we were before the oil price collapse, so about 2 years ago or thereabouts. And so, actually, almost 3 years ago now, really, when if we go to the end of 2014 is when oil prices really started to crumble. So I think what has happened is over that 2.5 years or so, the U.S. economy has gotten out in front of us, whereas we were roughly in the same place when the oil price did go down. And so now we're that couple of years behind in the cycle, if you like, compared to them, and that's why I was expressing the hope before that we will do similarly to what's happened in the U.S., is that they were able to grow farther beyond what most people thought was their capacity limit by pulling new people back into the workforce, and that's exactly what we think will happen here, but it's very hard to quantify. We just have to continue to watch it happen in real time.
So in terms of business investment, this committee, at least the subcommittee, traveled across the country in pre-budget consultation. One thing we heard a lot about the government's small business tax changes, but another thing we heard is that business investment would flow out of Canada into the United States. Do you feel that tax reform in the American context might cause the Canadian economy, would it not so much cost, but would you see more flows out of the country? And what kind of effect would that have?
Right. So this was a risk that we highlighted in our January monetary policy report, just very soon after the U.S. election, and at that time, the talk was very significant changes in U.S. tax policies, and the market had absorbed that as more or less as fact. And what happened over the course of the next 6 or 8 months is that market reaction has gradually been peeled back as the realities of the political process have unfolded. So we, of course, acknowledge this, but that there is potentially a risk that there will be a tax change that somehow makes, on the margin, it more attractive for a company to expand their operations or create a new operation in the United States. This is exactly the same strategy that companies are mentioning to us today in response to the risk around NAFTA. That if NAFTA were to cease to exist or be dramatically changed, one way for them to hedge against that risk, since it may take quite a long time for it to be clear, is for them to expand their operation in the United States instead of expanding in Canada. So this is a risk that we face today. In our forecast, we have lower investment spending expected for this reason, this uncertainty. And yet, as I said before, on top of that, there still does seem to be a strong willingness to invest, and the actual numbers showing it. So it's a mixed kind of picture. That's all I've got for you.
Well, I'm almost out of time, Governor, but appreciate you being here. Just a quick question in regards to different markets and how that works with inflation. Do you think that a lower cocoa bean price will cause more consumption by Canadian households of chocolates and in turn create inflation in the job market for dental hygienists, increasing inflation and ending up with kids with cavities? Do you think we should cancel Halloween?
Well, maybe I really don't think it's a good idea to cancel Halloween, and I even brought so. You cannot cancel Halloween. That's because I'm going to see my grandchildren after.
Is that it, Mr. Ellis?
Was that a trick or a treat?
I'll leave that to you, sir.
Okay, then next on my list is Mr. Sabara.
Thank you, Mr. Chair. I'll try to return some civility to the air. A couple of questions, actually. First of all, from the October Monetary Policy Report, I believe it's page 11, when we're talking about consumption growth and what the Canada Child Benefit has meant for Canadian families. I believe since the report was released, or in near the same term, we introduced on the Fall Economic Update the indexation of the CCB, which will give Canadian families $5.6 billion of extra spending for, I think, up to 2022-23, and about $500 million a year invested in the working income tax benefit, which I think is wonderful because, A, it hopefully draws in people that are not in the labor force to come into the labor force, and provides a cushion to folks that their marginal propensity to consume or invest is actually pretty high. So I was wondering if you can comment to that on what it could do to the Canadian economy in terms of firming up consumption going forward.
So, given that the announcement is not part of a formal budget, we have not worked that into our forecast for the economy. The indexation move or the income tax changes. That would be something we would do after a budget actually occurs. But we can talk about what the CCB that was put in place last year has done. We have estimated that it added approximately 0.5 percentage points onto economic growth over the past year. That is something which raises the level of GDP, but does not continue to contribute to growth. That effect is we believe over. It's 0.5 percentage points. To put that in context, would be that when the economy was at its weakest point and we had excess capacity, it was on the order of 2 percentage points of GDP, and so having that contribution from consumers meant that during the adjustment to the oil price shock, interest rates did not have to go lower, which was a beneficial effect.
Governor, we all know how hard it is to time fiscal policy or monetary policy, and fiscal policy, tends to operate. Monetary policy tends to operate more of a lag, but fiscal policy done right is right. And I think the CCB, from my view, was a timely measure introduced by our government. I'm going to ask two questions together, just so I can have the answers and don't run out of time. First off, they say the Lord giveth and the Lord taketh away. There was some monetary policy that was removed from the Canadian through your actions. And I'm just curious on the monetary transmission mechanism, in terms of the time frame that we're looking at to see how the rate increases are impacting or working on the economy. And with that, in your introductory comments, you talked about elasticity. And we know elasticity to a price change in terms of where household debt levels are, and how there may have been a structural adjustment in terms of how households respond to changing rates. And I was wondering if you can comment on more on the latter than the former, because that is important, because a small change in rates may have a larger impact than in prior years. And my second question You've commented about the economy operating at close to capacity, but your preferred measure for the labor market, your labor market indicator, demonstrates some slack. So if you can square the close to capacity, because I actually think I think the Canadian economy has actually grown in capacity or output potential. And if you can comment on that as well.
Okay, I'll take the second question and then I'll turn it over to Ms. Wilkins. So when we talk about the output gap or the economy's capacity, one is a broader concept than the other. The output gap refers to output, production, and we believe we are operating more or less at that level at this stage. But the economic potential is a broader concept which includes using all of your existing labor supply. And what we see in our labor market indicator in particular shows that it is still a percentage point higher than it was in 2007, whereas the unemployment rate is where it was in 2007. Well, that shows that those secondary measures of capacity in the labor market still have slack, and we won't be fully at our capacity until we've reemployed those resources through stronger investment. That's the process I was talking about before. So for a while, we have a gap between those two measures. That's as simple as that. Well, on to the interest rate elasticity, Madam Wilkins.
Sure. We made quite a bit of modeling changes to make sure we could capture the main channels, and the intuition behind why interest rates have a stronger impact when more highly indebted is pretty clear. I mean, if you have a $500,000 mortgage, 25 basis points is about $60 a month, and if it's that's going to take out of the money that you have to spend on other things. And so all else being equal, consumption is going to go down a bit or be less strong than it was. If you had a $100K mortgage, that would be $12. So it makes a really big difference. And it may be that it affects people differently over time, depending on whether they have a variable rate mortgage or a fixed rate mortgage. But eventually, that transmission gets through the system, and in general, it's a 6 to 18 months, 24-month process, and it flows not only through consumption but also through the price of houses. Because, again, if you're spending more of your income on something else, like interest rate payments, maybe you're not as inclined to buy a bigger house than you were. Maybe other people need to wait longer to buy a house, and so all these channels kind of come together to mean when people are more highly indebted, it's going to have a larger impact. And with our new model, we are more confident than we were in the past that we've been able to capture those effects.
Thank you. Thank you all. We'll go to Mr. Kelly and then Mr. Greywall, and we will have time for a couple of more if there's others. Mr. Kelly.
Okay, thank you. And I'm going to continue on the discussing some of the mortgage related parts that we've already begun today. And when it comes to housing, Canadians don't choose to be heavily in debt from mortgages because they want to. They tend to participate in the market that they live in, and the price is the price. And we know that in many centers the prices are very high, and if a person is going to own their own home, they must take on these large debts. I want to just make a comment about a point, Governor, that you had spoken about, the trade-off between a consumer choosing to pay the insurance fee for a high ratio mortgage as opposed to putting the additional money down. And I had been a mortgage broker for over 20 years, and when a borrower is confronted with the choice between a lower interest rate, paying an insurance fee that's amortized over the life of the mortgage, and being able to, the option then to put less money down, almost every borrower chooses the lower down payment. That's just a human nature type decision that most people will make. So this business about perverse incentives, I think maybe ought to be a concern over what behaviors are being encouraged.
Right. Well, to begin, there are more constraints than that on the system. For instance, the insurance market only operates up to $1 million. I know that sounds like a lot for a house, but in certain markets it is not. The other thing is that if we're faced with a choice like that, which way will people go? The data suggests, contrary to your presumption, which is that there's a lot more people that we're trying to have larger down payments, and I think it has more to do with their ability to qualify for rather expensive houses. It's very hard to know exactly what's going on, but we have a really big cluster of people at 79%, if you like, mortgages. So they've just made the 20.5 or 21% down payment. So there's some people are highly motivated to do the opposite of what you say, but then of course you have lots of people who also are at the other end. So I guess that tells us that it's a pretty personal choice.
I think in terms of the first-time buyer who is typically has to put together everything they can just to make the minimum, and if they are told that if they have their 20% or their 21%, but they could go with a little bit less down, and they would get an interest rate that right now, in some cases, up to 40 basis points better than the conventional rate, they would opt to do so if they had that incentive as well. But is there any concern about the extent to which some of the changes that have taken place, that the competitive pressures will maybe eventually drive borrowers away from lenders that are regulated by OSFI, the federally regulated financial institutions, and into other types of credit, which will be higher interest rate credit, and with all the consequences that we've already talked about in terms of the spillover into the rest of the economy.
So having alternatives to the traditional banks for a mortgage allows a market to be served that may not otherwise be served, and maybe at the right price, and that market is related to people who don't have a long credit history, but over time could get one. And so I think it's a very important market. And it is true that the more constraints that you put on the regulated space by OSFI, there is the possibility that would spill over to other forms of lenders. I think the question there is whether or not those lenders have as rigorous underwriting processes, and that's a question sometimes for provincial regulators who are well equipped to answer that question, not us, and as well the institutions themselves, and the fact that the price is higher may reflect the fact that the risk there is also higher. I think sometimes we think about, well, what's the right decision for me as a home buyer today? What makes sense and what price do I have to pay? Some of these ways of thinking about what you can afford over time take into account situations where things don't happen the way you'd like. Interest rates rise or the price of your house falls. And so I think these longer term, these rules kind of can serve to help households over the longer term for having a level of debt that's sustainable.
Okay. Quick question then about regional differences in not only the housing market but in the greater economy. I'm the member from Calgary, where unemployment is still uncomfortably high, and many people are very concerned about their jobs. How does perhaps either within housing or the broader economy do we address the regional differences that exist?
Well, the short answer would be not with monetary policy, since we only have one tool, and that's the interest rate. It's the same interest rate for everyone. And so this is almost always the case that there are areas or sectors in the Canadian economy that are weak while others are stronger than normal. There is absolutely nothing we can do except to pay attention to those details in terms of figuring out how things are evolving at the macro level. And for us, it's one macro economy, and that's essentially the way we look at it. And there are, of course, other tools in the policy space to try to address, developments in individual sectors or individual parts of the economy.
Thank you all. Mr. Graywall and Pierre, will come back to you for a question as well. Mr. Graywall.
Thank you, Mr. Chair. And Governor, you're way too young to be a grandfather.
No, I'm not.
I know. Well, having the governor as a friend is never a bad idea. Governor, you mentioned that your number one tool in terms of monetary policy is the interest rate. A lot of Canadians, even if they don't have a finance degree, recognize when the Bank of Canada reduces the interest rate, it's generally to help stimulate the economy. Why would the Bank of Canada increase the interest rate?
So I think it's better to start the story about why did we reduce interest rates in 2015. We did so because the economy was hit by a very significant negative shock, the fall in oil prices. As I mentioned earlier, it had the effect of taking $60 billion a year of income out of our economy. It was a very significant shock. And so the adjustments to that would mean cutting back on investment, cutting back on consumption spending in the affected areas in particular. And by cutting interest rates, we were able to smooth out that process. It didn't make it that much easier for folks in Newfoundland, Labrador, Saskatchewan, or Alberta, but it did make the rest of the economy adjust more quickly. It caused the exchange rate fell more than otherwise would have been the case, and speeded up export growth in other sectors and so on. That's the full story. So the question is then, well, why would you raise interest rates? Well, because the adjustment that was going on in a macro space, not in every region, but macro, is complete. And so when we look at why did we do that, it's because we would have undershot our inflation target significantly had we not reacted. By cutting rates, we were able to project that inflation by sometime in 2018 would be back to our target. And now, if we did not move interest rates back to a more normal level, then we'd be at higher risk of exceeding our target.
Thank you, Governor. You said in your testimony today that growth in housing is projected to slow further, in part because of the measures introduced by the Ontario government. And we also have the new mortgage rules coming through by OSFI, which a lot of my colleagues on this committee addressed. The anticipation in the market is that that's going to further reduce and slow down housing. How will that impact growth on the Canadian economy from a macro level?
Right. We estimate, and this is, of course, this is not especially the changes to OSFI's rules and other changes are not the normal things that are in macroeconomic models. So whereas interest rates are obviously in our models. So it requires a little extra and more innovative analysis. We have micro data, which was alluded to earlier. We know, for example, in 2016, how many people who qualified for mortgages in 2016 will not qualify for them under the new rules. So we were able to do almost a simulation as if we had put the rules in place earlier. How many and how much, less borrowing. So we can do that, and we can then translate that into an approximate effect on the economy on the order of 0.2 or 0.3 percentage points on the subsequent year or two of GDP. So it could be, if it's in growth, it might be half that over 2 years, or if it's faster, it'll be all in 1 year. But importantly, it depends on how it's an individual decision how one reacts. So here's the new rules. What do you do? Well, this is the house I wanted to buy, and now I don't qualify. So is your reaction to postpone for a year? Possibly. Is your reaction instead to say, well, I think the house next door, which is a little smaller, suits my needs as well, so I'll buy that one instead, in which case you still go ahead with the transaction. And so it's very hard to know how it actually translates into GDP impact. So exactly why we say with the new level of interest rates today compared to 6 months ago, we need to monitor very carefully how people are actually behaving in real time. We can't just rely exclusively on our models to do that.
I agree with you, Governor, that it is very much, it could be reactionary, it could be positive in certain markets, it could be negligible in certain markets in terms of most assumptions are, and there are assumptions that in Vancouver, in Toronto, the changes won't have too great of an impact because just of demand in housing will keep pushing it along. But because Canada is very much a regional-based economy and it will differ, and it will have disproportionately negative impacts in the East Coast provinces and some of the prairie provinces because housing, people won't qualify for mortgages anymore. And so I think that, that's something that only time will tell as the policy is rolled out. Deputy Governor, you said that my colleague asked a question on data in terms of fixed rate mortgages. I'm assuming you guys also track the default rates on mortgages as well across the country?
Yes.
And has there been significant movement in the last 12 months after the measures in the provincial government in Ontario, BC, and federally were announced?
They're very low.
They're minimal. And has Alberta recovered in terms that there was a spike after energy prices fell in defaults in the province of Alberta?
Edged up a bit. Actually, they edged up to, I'm sorry I interrupted you. They
That's
edged
okay.
up to meet the national average, in fact, because they were lower before.
Okay.
Yeah.
And what is the national average?
The actual number, gosh, I have 0.3 or something in my head. It might be slightly higher, but I think it's under 1%. But I can get back to you with the actual number.
Yeah.
Okay, perfect. Thank you.
It's a decimal point of 1%. It's a low number.
And so now my last question would be then why so much proactive regulation on mortgages?
Well, and so our concern is, as I've described before, with the vulnerability of the economy, not that there's some form of a wall there, but if the problem is that the economy is more vulnerable to future disturbances like the oil shock, that kind of shock that's unforeseen. And it's the vulnerability we've characterized in the past like a crack in a tree, which the tree looks fine, it's all fine, except when just the right storm comes along and then the tree is on your neighbor's house when you come home. That makes for a bad day, right? So the point is that the economy then magnifies those shocks and we get an even bigger rises in unemployment and financial stress in the financial system when debt is high. And so the main point of these things is to make sure that the economy is more resilient in future, so that if you've been tested for a 2 percentage point higher rate of interest and your circumstances would allow you to ride through that through a 2 percentage point increase at renewal, well then we can be confident that things that transpire between now and then are not going to upset the system. And it means that the system, all the new debt that's arriving in the system now, is making the system much more resilient than it was in the past.
Okay, we'll have to leave it. Let's take your 10 seconds.
Sure. My last question, so that was the positive angle of having proactive regulations on mortgage. The negative angle, many people would argue, especially former colleagues on Bay Street, is that it slows the ability, especially for first-time home buyers, for qualifying and making that leap into the housing market.
Yes, it does.
Okay, then we've got time for about 3 more questions, 3 minutes. Before I go to Mr. Dussault, in your remarks, you partly answered this question earlier to Ms. O'Connell, but you said the second issue is the degree of excess capacity in the economy and slack remaining in the labor market, and you used the example of participation rate of young workers is below trend and average hours worked are less than we would expect. When we were on the road, as we've been for 2 or 3 weeks with the pre-budget consultations, I think we heard everywhere the need for greater education, more skills training, matching skills to meet jobs, etc. I'm not asking for you to suggest policy, but I'm basically asking you for what's your analysis? Is there a problem with skills in the labor market that you're seeing in your analysis? Is there more part-time work than there is full-time work? What analysis does the Bank of Canada have there?
Well, all of these things may be true, Mr. Chairman. We know there are structural changes in the economy, an extra growth in part-time working arrangements as opposed to full-time arrangements. We know that's a fact. But taking account of those things, it still appears to us that there is excess capacity in the labor market. It is primarily a youth thing, but not entirely. So we have 5 percentage points lower participation in the workforce by youths, 15 to 25, than we had prior to the great financial crisis. Now, I realize the people that we're talking about different people now because 10 years have gone by. And they may be staying in school longer, which is all well and good. We often get that effect out of recessions. People spend more time at school. But the fact of the matter is that we believe there's extra capacity there, and we've tried to quantify that in a separate paper, which was published alongside our monetary policy report. And so, in fact, we simulate there the effect is if we're able to get an extra 1 percentage point of extra economic capacity by this reintegration in the workforce, more conversion from part-time to full-time, and reparticipation by those youths. And that is a very significant thing for us to achieve, whether by helping through other policies to make it easier, reskilling, et cetera. I think all those things can help us. But it also means that to the extent that it occurs, we will undershoot our inflation target 1.5 to 2 years from now. And therefore, we have to watch for it happening. And hopefully it happens to a certain extent. We can allow it to occur by watching it unfold and not nipping it in the bud.
Okay, thank you. Mr. Dussel.
Thank you, Mr. Chair. I think earlier you referred to e-commerce and the scope it has in the economy in the digital age. It goes without saying. E-commerce is profitable for Canadian businesses and especially for foreign companies that are flooding the market with products that some may say are of poor quality and at a low price. So on that issue of e-commerce, especially at the retail level, but also in other areas, for example, in the cultural sector, do you have data on that issue, on e-commerce, and the scope it has in our economy today? Do you have a forecast or concerns regarding the breadth of this and the competition for our Canadian companies that have to compete now with these businesses? There's the example of China that can send products here at a very low cost through the mail. Is this something that's on your radar? Of course, it is on our radar. Given our mandate, it's no surprise that we focus more on the effects on the inflationary process, but also on the possibility of having transition costs in the labor force when there's a changing nature of work and the effects on wages. Regarding inflation, we've done a number of studies that have been published. They were published a week ago. It's very interesting because it demonstrates that the effects of e-commerce on inflation in Canada at this point don't seem to be very significant, even though we hear a lot of anecdotes that could indicate otherwise. One part is that the take-up of e-commerce in Canada isn't as high as in Sweden or Europe, for example. At the same time, it could come. It's another type of competition for Canadian companies, for jobs. We don't see the effects of digitalization on productivity for now, but the nature of work may be changing a great deal in the future. We have to be ready for that. For people entering the labor market and also those who are already there. And so it becomes a matter of training and education. But those aspects are not part of the bank's mandate. So we conduct studies to better understand this. Thank you.
Poilievre.
Governor, you spoke about some of the reasons that inflation has been so moderate for so long. I think two examples you gave are low-cost imports and technology. These factors are unpredictable. We don't know exactly what technology will do to our costs into the future because, by definition, all technological developments involve introducing something new and unknown. Over time, the low-cost imports may become more expensive as labor costs rise in the developing world. Do you have any concerns at all that inflation into the medium term might be higher than the consensus view?
Well, those of course, exactly the questions that keep central bankers awake at night. So I won't deny this. But most of the history of technological improvements, or if you like, the effects of globalization or supply chaining on the inflation process, have been to reduce inflation below what its trend line had been. And this is what we call positive disinflation. It means that people are getting things for less money, and so it would be odd for a central bank to try to boost inflation in other parts of the economy to try to average it out to be exactly 2%. So it's the kind of thing we would normally see through precisely for that reason and because it's unforeseeable, as you say. Quite similar to an exchange rate effect on inflation, which is transitory one way or the other. We would see through it. Our greater concern, and this is how the risks become balanced, is that we are now at a place where we're operating more or less at capacity, and we believe there's extra capacity, but it has to occur for it to be relevant. And if there isn't, it means that we'll be into the excess demand space, and inflation fundamentally will begin to pick up. And we would see that in the labor market first. This is why we watch each of these things as we go along. And so we're in that zone where the risks are truly two-sided, up or down on inflation. So of course we worry about both sides. But given our history, where we've been for the last number of years, we're much more preoccupied with the downside risks.
One of the drivers of growth in the last couple of quarters has been residential construction. As consumers become tapped out and are no longer able to add debt in order to purchase housing, and as prudential measures pile on one another, both from provincial and federal governments, housing prices are expected to moderate. What impact do you expect that will have on the very large segment of our growth that has relied on residential construction?
So you're absolutely right that residential construction has been our leading growth sector throughout this very low interest rate period since the crisis. But our forecast is exactly that. It would become a much less important contributor over time to growth. And instead, what we get is leadership from investment as firms expand capacity, as discussed earlier. And of course, with that, the export behavior, which is picking up in new export sectors. So that's exactly the shift in growth leadership, or the rotation, if you prefer the term, in demand that we're expecting to see, and we've begun to see it this year. Housing was a negative contributor in Q2 to economic growth, and we expect it would be probably flat again in Q3. But the big numbers that you saw were from all the other things that are growing.
Finally, you commented on the ability of Canada's interest rates to diverge from American interest rates, but your commentary, I noticed, was on the divergence of trajectory and not on the actual numeric rates themselves. How big a divergence is sustainable given the massive integration of the Canada-U.S. economies?
Well, this is a question which depends on the divergence in the inflation paths in the two countries. And so the example that I gave, there was a swing of some 75 basis points between Canada and the United States during 2015. There have been other episodes similar to that. The truthful answer is it only depends. I couldn't speculate on what is the maximum divergence we could sustain, but it would just depend on the other underlying shocks. I remember studying the early 1970s when Canada first, went back to a flexible exchange rate. There was a massive divergence between the Canadian and U.S. economies at that time, and the exchange rate, as soon as it was unleashed, rose by some 10 cents in a very short space of time because of that divergence. So really, I think the most important thing that helps us equate when there is a divergence is the exchange rate. That interest rates are less the engine of correcting that. They're more of a facilitator, if I could put it this way.
Thank you. Mr. Sabera, last segment.
Thank you, Mr. Chair. Governor, you had commented, or even the Deputy Governor commented on the labor force productivity in the last year or so, showing some pickup in trajectory. I was just wondering, what do you think is behind that pickup, and how important is it to raise the standard of living for all Canadians to get that labor force number going in that way?
Well, productivity in Canada is growing sufficiently strongly now, in aggregate, somewhere around 3%, and in the goods sector, more than 4%, which is quite unusual. So that suggests to me that it's, for the most part, a cyclical thing, which will slow down to something more normal in the near term. But that remains to be seen. What I think it reflects is the transition of the economy in the wake of the collapse in oil prices, the shrinkage of the oil sector, and then the expansion in other sectors is coming in a high productivity areas. And so that's something that will continue, provided that those two growth tracks remain in place. It's crucial that we get that behavior, because that is the basis for expanding incomes. Okay, right now, actually, Canada's costs, unit labor costs, are actually falling relative to the United States, but falling in absolute terms, because productivity is outpacing wages. So what we'd expect to see in the near term is that things will pick up as the excess labor is being picked up out of the labor market. Wage growth is going to pick up because companies can afford it.
Thank you.
Thank you. That will end the session with the Governor and Assistant Deputy Governor. Thank you very much for your responses to questions. And committee members, we will suspend for about a minute and then deal with the committee business before we start with the PBO. So thank you again, Governor. Meeting suspended. Find my agenda before we reconvene. We shall reconvene. Before we start with the parliamentary budget officer, we do have some committee business to deal with. Members have a report from the subcommittee on committee business going forward, and I'll just go through it, and then we'll see if there's questions. Point one, we talked about this morning. We had a little bit of difficulty figuring out how to deal with embargoed copies, but what we agreed on is that an embargoed copy of a report from the Parliamentary Budget Officer 24 hours before it is made public, that report be distributed to members of the committee, and the report remains confidential until it is made public by the PBO. Point one. Point two, in regard to the pre-budget consultations, it's explained out there in the motion. A couple of things that people may not be aware of. We agreed that the draft report contained an executive summary describing the main themes of the report, and that the committee include a statement from the trip to Washington, D.C. and New York in the report, that the parties submit their proposed recommendations to the clerk in both official languages no later than 5 p.m. on Thursday, November 30th. The committee meet on Monday, December 4th, 2017, and Tuesday, December 5th, from 3:30 to 5 to consider the draft report. The committee meet on Wednesday, December 6th, from 3:30 to 5, if necessary, to further consideration of the report. So that is all on the calendar that is marked in yellow there. That the clerk proceed with planning the committee trip to Washington and New York according to the draft itinerary as discussed by the subcommittee. Then point four, turning to Bill C-63, the Budget Implementation Act. I think it would be better to explain this by the calendar rather than going through the recommendations that's there before you. On November 2nd, the committee would meet with departmental officials on November 2nd. And at 5 p.m. would be the deadline to submit the witness lists for Bill C-63 to the clerk. On Tuesday, November 7th, the committee would meet and hear from 12 witnesses or thereabouts. On Wednesday, November 8th, and this relates, Pierre, to the motion that you had tabled, that we would meet with the minister from 3:15 to 4:15 on supplementary estimates. We would discuss we would have the minister before us from 4:15 to 5:15 on the bill itself, Bill C-63, and if necessary, from 5:15 to 5:45, we would deal with the remaining representatives from the departments. On Thursday, November 9th, we would again hear from witnesses from 3:30 to 6:30 related to Bill C-63, and that would be in the range of 2 panels, 6 witnesses each. On November 16th would be the deadline to submit amendments for Bill C-63. 12 p.m. would be the deadline. And then on Monday or on Tuesday, November 21st, we would go through clause-by-clause consideration of Bill C-63 and be in a position to report it back to the House. So that deals with the Budget Implementation Act. Yes?
I just want to confirm that that would be an all-day.
That'll be in...
As long as it's necessary.
We have to finish by, what's it say in the motion here, 9 o'clock that night?
Well, at 9 o'clock we put the question on all remaining amendments and
right here. So I'll read this into the record so we're clear. If the committee has not completed the clause-by-clause consideration of the bill by 9 p.m. on Tuesday, November 21st, 2017, all remaining amendments submitted to the committee shall be deemed moved. The chair shall put the question forthwith and successively without further debate on all remaining clauses and proposed amendments, as well as each and every question necessary to dispose of clause-by-clause consideration of the bill, as well as all questions necessary to report the bill to the House and to order the chair to report the bill to the House as soon as possible. So that would be fini on the bill. So point 5 is we dealt with, I mentioned that would be dealing with the supplementary estimates B, and the Minister of Finance, as I mentioned, would be before the Committee on Supplementary Estimates on Wednesday, and as well that the Minister of National Revenue and department officials would appear before the committee on Thursday, November 23rd, on the estimates for that department. And that's the report. Is it so moved? Any further discussion? All those in favor? Opposed? Carried. So be it. So thank you, PBO officials, for your indulgence while we deal with that matter. Then pursuant to Standing Order 1082, a study of economic and fiscal outlet, we have before us for this panel the Office of the Parliamentary Budget Officer, Jean-Denis Fichette, PBO, and I'll let you introduce your people, JD, and floor is yours. I know you have an opening statement. Welcome.
Thank you.
All.
Thank you, Mr. Chair. Messieurs les vice-présidents.
Vice chairs, ladies and gentlemen, members of the committee, my colleagues, Mustafa Askari, who is the Deputy Director, Parliamentary Director for Budget, as well as Chris Matthews, who is the Principal Analyst, and Trevor Shaw, who is also an analyst, are here with me. We thank you for allowing us to appear before you today to discuss the October 2017 economic outlook, which it reflects what we are doing, that is to say have greater transparency in financial matters.
Prepared in response to the motion adopted by this committee on 4th February 2016. However, since then, the PBO legislation under the Parliament of Canada Act was amended. It is therefore in accordance with that legislation that we provided yesterday a copy of the report to the Chair and the Clerk, and we made the report available to the public one business day after, that is, this morning. Now back to the report. The economic outlook. The Canadian economy advanced at a robust pace in the first half of 2017. However, beginning in the second half, we project that growth in consumer spending will moderate and residential investment will continue to decline as borrowing rates rise and disposable income gains diminished. We project real GDP growth to slow from 3.1% in 2017 to 1.9% in 2018, and then average 1.7% annually over 2019 to 2022. Nominal GDP, which is the broadest single measure of the tax base, is projected to grow at 4.1% annually on average over 2017 to 2022. Compared to our April outlook, the projected level of nominal GDP is broadly unchanged. Nous prévoyons que la Banque du Canada.
We assume that the Bank of Canada will maintain its policy interest rate at 1% until January 2018. As core inflation continues to firm through 2018, we project that the Bank of Canada will gradually increase its policy rate by 25 basis points each quarter until it reaches the neutral level of 3% by the end of 2019. Our economic outlook reflects the view that a possible upside and downside outcomes are, broadly speaking, equally likely. In terms of downside risks, we maintain that the most important risk is weaker business investment. However, in terms of upside risks, we maintain that the most important risk is stronger household spending.
The budgetary deficit in 2016-17 was $17.8 billion. This is $2.8 billion lower than what we projected in April, reflecting lower than expected direct program expenses due in part to an estimated $2 billion in unspent infrastructure funding. For the current fiscal year, 2017-18, we expect that the budgetary balance will show a deficit of $20.2 billion, which is 0.9% of GDP. We project that budgetary deficits will decline gradually, falling to $9.9 billion, 0.4% of GDP, in 2022-23. Lower direct program spending accounts for most of the reduction in the deficit over the projection horizon. Compared to our April outlook, we are projecting budgetary deficit that are $2.2 billion lower on average over 17-18 to 2021-2022. In budget 2016, the government committed to reducing the federal debt to GDP ratio to a lower level over a 5-year period ending in 2020-2021. This translates into a fiscal target of 31% or lower for the federal debt to GDP ratio in 2020-2021. Under current tax and spending plans, we project that the federal debt to GDP ratio will be 29% in 2020-21, which is 2 percentage points of GDP lower than the government's target. Compte tenu des
Given the possible scenarios surrounding our economic outlook, and on a status quo basis, it is unlikely that the budget will be balanced or in a surplus position over the medium term. However, it is likely that the federal debt to GDP ratio will fall below its target level of 31% over 2017, 2018 to 2022 and 2023. We estimate that there is approximately a 75% chance that the federal debt to GDP ratio will be below its target in 2021. Lastly, in our report published today, we also provided some tables comparing our economic and fiscal projections to the government's projections presented in the fall economic statement. Consistent with the PBO's legislated mandate, we plan to publish an analysis of Finance Canada's fall economic statement in the coming weeks. My colleagues and I would be pleased to respond to any questions you may have regarding the outlook or anything else.
Thank you very much, Mr. Fischette. I think we have time to go the first round for 7 minutes, and we'll recalculate after that. Mr. Savara.
Thank you, Mr. Chair, and welcome everybody. Bienvenue. Just in your opening remarks, sir, and you make the comment of possible upside and downside risks And you mentioned the downside risks on business and weaker business investment. In the monetary policy report that the Bank of Canada published, and we just had the governor and deputy governor here, the BOC has business investment actually firming and stabilizing and contributing positively to Canadian GDP, and less so on the residential investment side, but on business investment side. So if you could just comment on that business investment comment that you have there, and also if you can just, if you had to pick your top 3 downside risks and top 3 upside risks for the Canadian economy, please.
Thank you for the question. Chris?
Thanks for the question. On the on business investment, our outlook over the first 3 years actually is a bit stronger than the Bank of Canada's. We have actually a bigger rebound in business investment growth. At the same time, we also have a more, let's say, negative outlook on the residential sector. So we have a bigger decline in residential investment over that period. And part of that, as the governor mentioned, I caught the last couple of comments. That investment helps to increase the productive capacity of the economy and boost potential growth. So that's being reflected in our outlook. The risks that we identified are definitely what we see as the most important upside and downside risks. I'm not sure I can give you top 3 and top 3, but the other, or top 3 and bottom 3, but the others that are definitely under consideration relate to U.S. trade policy. And again, this is something that several other forecasters have pointed out, the uncertainty around NAFTA, of course. But then on the opposite side of that, coming from the U.S., is U.S. fiscal policy, and talks about tax reform, tax reduction. So we see that as a possible upside. And the way we've treated that in our forecast is that we've just assumed that they would be offsetting. Now that's definitely a judgment call, and we're open to that. There's some other global and domestic. On the domestic front, we could see a sharper correction in the residential sector than we currently have. We think that it's considerable, but given some of the recent changes on the mortgage underwriting guidelines, and the maybe a larger impact of the expected increase in interest rates, that could have a more negative impact on the housing side. Our export outlook is also, I would say, very. I don't want to say it's optimistic, but we do at least relative to the Bank of Canada's outlook, we do see a bigger pickup in terms of growth in export volumes. So maybe on the downside, if we do see another sort of, let's say, persistence in competitiveness issues for Canadian exporters, we might not see that rebound. So those are about probably the top 2, bottom 2.
Thank you for that commentary. Regarding Canada's fiscal position or fiscal capacity, what percentage of, when we talk about the deficit, what percentage of GDP is that currently right now?
It's in the current fiscal year?
Current.
It's 0.9% of GDP.
0.9%, not even
So
1%.
less than 1%, yes.
Less than 1%. And the trajectory towards, as a percentage of GDP on an annual basis, is continuing to decline, I would take that.
We're projecting it to decline to 0.4% of GDP by 2022-23.
And what is the U.S.'s position? What is the U.S.'s deficit as a percentage of their GDP?
Off the top of my head, I believe it's roughly around 3.5% of GDP currently.
Okay. Thank you on that. And it's great to see that when we look at fiscal anchors, that we have the debt to GDP number declining in this current trajectory, and potentially hitting below 30%. Is that correct? Right.
Yes, we have the debt to GDP projected to decline to 29% of GDP.
Okay. And I say that because as we are doing, as the debt to GDP is declining and as the deficit as a percentage of GDP is declining, we're obviously undertaking strategic investments in our economy, including the Canada Child Benefit, which in the last testimony provided a 0.5% increase to GDP. Have you any estimates on what the Canada Child Benefit, what the impact was in your modeling on the Canadian economy?
Unfortunately, in this outlook, we don't have an estimate of the impact, but we have incorporated it into our outlook for consumer and household spending. So it's in there, but we haven't isolated it. I believe the last time that we provided an estimate of this was back in our April 2016 economic and fiscal outlook, and I forget off the top of my head what that impact was.
Thank you for that analysis, and I take it once the legislation comes out, or with the indexation of the CCB and the working income tax benefit, that the PBO will providing a more thoughtful analysis on that front there. Finished, sir. Yep.
Okay, Mr. Poliev.
Thank you for being here. Between now and 2022, 5-year period, public debt charges, that is interest on the national debt, is expected to grow from $24 billion per year to $38.5 billion a year, which is an increase of $14.5 billion, or 58%. Can you confirm that this annual expenditure of $38.5 billion for debt interest is money that the government cannot allocate to fund health care or other valuable services that Canadians use?
Yes, of course, you're correct. And that's the expense of the government, and they have to manage that within the envelope that they have in terms of revenues and the amount that they borrow.
So this $14 billion is the increase in debt interest that the government will have to shoulder, that taxpayers will have to cover. Is that a significant amount of money in the context of the overall Government of Canada budget?
In terms of the overall size of the economy and where we are going, no, it is not a big amount. But I mean, the reason for that is twofold, actually. One is the interest rates are rising in our projection, and that's obviously one impact on the public debt charges. The other one is that the government continues to have a deficit over that period, so that accumulates over time with a higher debt level, so that will increase the public debt charges.
And interest rates, you mentioned that interest rates are rising. How much would interest rates need to rise before heavily indebted Canadian households begin to feel financial distress?
Well, we did a study earlier this year, which we looked at the Canadian households' debt and their debt service ratio, and we showed that over the next 5 years that the service ratio will increase. And that is obviously a pressure on households in terms of their finances, because as the debt service ratio goes up, means that they cannot spend the money on other things that they normally spend. So there is certainly an increase and more pressure on households. Whether that's a crisis or not, that's a different issue. I can't really say whether that would lead to a crisis for households, but certainly it would increase the pressure on households.
How much could these households absorb in the way of interest rate increases?
How much would they be able to absorb? That's hard to tell. Chris, you have any views on this?
No, we don't have an estimate of what the sort of maximum threshold is, but what we provided in that report was basically a comparison over the last, I think, 25 years, and what we projected was that if as expected, the Bank of Canada's interest rate rises back up to about 3%, which is its midpoint of its estimates for the neutral rate of interest, from current levels, we would expect to see household debt servicing rise from about 14.2% of disposable income to 16.3%. And relative to the long-term historical average, that's about roughly 3.5 percentage points above its long-term historical average.
Have we ever seen household debt service ratios that high in the past?
No, historically speaking, I think the highest was about 14.9, around 15% of disposable income, and that was during the global financial crisis when incomes really collapsed.
Let's just get this straight. By 2022, is that the year?
Roughly.
By 2022, in 5 years, interest rates are estimated by your office to be at 3%, and that will lead to the highest levels of household debt service costs on record.
According to our projection, yes.
And at that very moment, those same households will be bearing the burden of $14 billion in additional interest costs that their government will pay for its growing national debt.
Well, they will not be paying the debt charges themselves. That will be the government issuing debt on financial markets.
Right, but if they don't pay, government doesn't have any money, so somebody's going to have to pay for it, and that means taxpayers. They can issue new bonds, but ultimately somebody's got to pay interest on those bonds.
Yes, and they will be rolling over their debt as it does become due. Yes, unless they stop issuing new debt.
Right, but whether they issue new bonds or treasuries, can somebody tell me where the money comes from to pay interest on government debt?
It partially comes from current revenues and partially comes from issuance of new debt. And so in our
revenues come from, though?
Ultimately, that's coming from the national economy.
Right. And who in the national economy pays those revenues?
That's the household and the business sector.
Right. Yes. So the same households that are going to be faced with record high interest payments on their own debt will also be paying $14 billion in additional taxes on the government's debt.
Well, sorry to go back, but their taxes aren't going to be rising. The government is borrowing to partially finance those expenses.
Yeah. So again, I think we're coming to the same conclusion. One that the current government is having a hard time accepting that all the money that funds the government, literally 100% of it, comes from taxpayers, and there is no other ultimate source of funding. There are temporary sources of funding in the way of borrowing, but the government might find this surprising, but debt actually has to be repaid.
I guess that's a point and not a question. So we'll turn to Mr. Dussault.
Merci, Monsieur le Président.
Thank you, Mr. Chair. Thank you to all of you for being here. I saw something from my friend Jason on Facebook. It highlighted the difference between $1 million and $1 billion. And here we're talking about billions of dollars for the debt level. As my colleague mentioned, he compared 1 million seconds to 1 billion seconds. A billion seconds is 11. A million seconds is 11 days, and 1 billion seconds is 31 years. So that gives us an idea of what it means to have an addition from $24 to $38 billion. But I'd like to ask about Table 5 on income, on business tax income. Did you take into account the small tax business rate decrease from 10.5 to 9%? No, we didn't factor that in. Trevor?
Statement. have been included in our overall revenue and expense projection.
OK. Et est-ce que c'était quelque chose qui avait été...
And is it something that was factored in by the government in its last two budgets for its forecasts, that the business tax rate would be going down to 9%? In its last budget or in the announcement? In the previous budget forecasts, did they plan to decrease from 10.5 to 9%? No, not in the last one. It was announced in the fall economic statement, but not before that. That's rather surprising, given that the government implies that it had been planned from the beginning, that decrease in the small business tax rate. It was an election promise. They said it was planned, that there was no surprise. But economic forecasts did not take into account that decrease, so it's a surprise that we need to highlight, because the NDP has been calling for this for a long time. Regarding EI, Table 7 rather, looks at forecasts for the EI program, and my question has to do with the fact that there's an increase in contributions, and I wondered how that could be explained, because the unemployment rate has been decreasing, and in spending we see that benefits are increasing to 24.9%. So how were those forecasts reached, given that the unemployment rate has been decreasing? To give Trevor a few seconds, there was a change in the law that $2.5 billion surplus until the end of 2016. Based on the law, there needs to be a level of balance to meet the necessary payments until the end of that period. Trevor, would you like to add something?
The current unemployment rate and eligibility, let's say, of unemployed peoples for EI benefits. But we also need to forecast this out into the future because of this 7-year break-even rate. And so if, based on our economic projections, if the unemployment rate is set to rise or decrease, this is going to have an influence on our 7-year break-even rate. So our anticipation for benefit payments as part of the EI program going out to 2023, 2024, all of this is going to affect the break-even rate, not only for the next year, but all the subsequent years as well.
D'accord. Sinon, sur le tableau 6.
Okay, regarding Table 6 now, that I was referring to earlier. Regarding spending. For program spending, it's increasing by 1.2%. I'm looking here at the increase for direct program spending. So that increase is 1.2%, but based on different collective agreements for the public service, there are salary increases that are higher than 1.2%. So I was wondering how those numbers were reached. For higher program spending, when wage growth for the public service is higher than that. The answer is rather simple. To arrive at these results, there has to be a decrease in the number of people employed, because we know that payroll, we're talking about payroll and benefits, or there's stagnation in public service jobs, or there's attrition. Is this something that's corroborated? Does the government also say that that's what's being planned? That there would be lower staffing levels, or that there would be attrition? Not yet. What we see is that the decrease we see in the deficit is based in part on that level of decrease in spending. hasn't been said yet, but all the collective agreements have not yet been signed either. So I think at a certain point there will be an announcement made. So as we sign collective agreements, the final result in terms of debt may increase. If there's higher costs for spending because collective agreements have been signed, the final debt may increase. That could be the case. If we maintain the same employment levels, or if the number of jobs goes up within the public service. Would you like to add something? The government must find the funds for the program spending. This is a question we've asked in our April report. There's a challenge for the government in terms of managing operational spending because collective agreements indicate that salary increases is about 1.5%. And currently operating costs are increasing by about 0.8%. So there's a variance between the two. It's a challenge for the government to manage these operating costs. In other words, it's not viable for now over that period of time. Quite right. It raises concerns as well. We are out of time, but thank you very much, Pierre. And now, Raj Grewal.
You've aged considerably since the last time.
I'll try not to take that personally.
Nor should you.
You my time earlier on.
I know. I do appreciate that. My sincerest apologies. Thank you to the witnesses for coming. I really appreciate it. Our government committed to reducing the federal debt to GDP ratio. In our economic forecast, we had it to 31% in 2020 to 21. And your office is projecting it to fall to 29%. What's the reasons for the 2% difference?
Well, the trajectory for the fiscal deficit has changed. It's lower now than what the government was forecasting at the time and what we are forecasting right now. So that sort of translates into lower debt to GDP ratio relative to what was predicted before.
You commented in your report that the government has flexibility within its current fiscal plan to reach its medium-term debt to GDP target. Can you expand on that a little bit?
Well, the only thing that means is that mathematically, since the target was 31% and now they have 29% that they reached it, so there's that gap. That gap between 29 and 31 is the extra room in a sense that if they want to maintain that 31%, then they have that room. That's not a recommendation or anything like that. It's just explaining mathematically the difference between the two.
What do you see as the biggest challenges for growth in the Canadian economy over the short term and long term?
The biggest challenges? That's a very good question. Pardon me?
Productivity gain.
Well, of course, yeah, productivity gain. Productivity is always an issue for the Canadian economy, and as you heard from the governor recently, we have seen an increase in productivity. Whether that is sustainable over time or not, that's the major question. Certainly, it's not sustainable at the rate that we have seen in the past few quarters, but we definitely that's a major issue for the economy, and that requires investment, and that requires a better export performance in the economy. So all those things obviously are challenges that any economy faces. How you resolve that, how you achieve that, that's another question which I cannot answer.
In terms of the economy has grown really well, higher than expected this year. So the government is obviously considering that that there will be a little bit of a slowdown going into the balance and going into 2018. What do you think about in terms of trade and the uncertainty with our partners down south that will have an impact on the Canadian economy, or the uncertainty maybe creating an impact on the Canadian economy already?
Well, as Chris mentioned earlier, the issues with trade and uncertainty with NAFTA and the negotiation with the United States, we haven't taken that into account explicitly in our projection, because it's very hard to know exactly what is going to happen, how the negotiations are going to end at the end. But that's certainly a downside risk in that sense if the negotiations don't go, in our favor. But on the other hand, there are other things that we have not taken into account in that respect, is that the U.S. economy may actually perform much better than what we are assuming in our projection, given that they are planning to significantly reduce their taxes and invest in infrastructure. So those things are on the two sides of this, and we haven't taken those into account. But trade is always an important issue for Canada, given that we are in a small open economy. And certainly that uncertainty is important. But as I said, we are expecting that the trade will actually contribute to growth over the next 5 years. But that's always subject to some risk and uncertainty, certainly.
You mentioned now that a strong U.S. economy, how does that benefit the Canadian economy? Is a stronger U.S. economy good for the Canadian economy?
Certainly. I mean, the stronger U.S. demand will certainly boost our exports, and that's always the case. We are highly integrated with the U.S. economy, so any positive change in the U.S. will affect us positively.
What about the Canadian dollar relative to the U.S. dollar? There's going to be a happy medium there in terms of the Canadian dollar strength.
The Canadian dollar has some impact, certainly, on our trade, and where it goes and how it evolves over time will have an impact. But Canadian dollar always fluctuates, and again, in our projection is very a conservative, prudent, projection for the Canadian dollar underlying our projection. So it's not a major factor in that sense.
There was a report in a book issued last week on productivity, and that Canada is not meeting its potential in terms of productivity because of a shortage of people. There's a shortage of Canadians, and that if we were to increase immigration levels, that productivity would also increase, and it'd be really good for the Canadian economy. This may be outside the scope of your the Parliamentary Budget Officer's mandate, but I would just love your comments on that.
Well, I mean, in general, I think linking productivity growth to immigration, to me, is a stretch, because it depends on what immigrants will do, and that requires investment, that requires other factors that will boost productivity. Now, the issue of productivity is a complicated issue, and it's an issue that is very hard to track and understand. I mean, you look at what the Canadian different governments have done over the past 20-25 years, many things that are considered to be the right things to do for boosting productivity have been done. But unfortunately, except for the last few quarters that we have seen a boost in productivity, we haven't really seen the results of those policy measures. We have seen tax cuts, we have seen investment in innovation and in those kind of things, but we haven't really seen the result. So it is a puzzle. In what sense it's a puzzle for policymakers and how to deal with that.
Thank you. Thank you, Mr. Chair.
Thank you. Turning then to Mr. Albas, and we'll go at least 6 minutes, Dan.
Thank you, Mr. Chair, and thank you to the work that all of you do for Canadians and for parliamentarians especially. Now, in regards to the report, I'd like to actually follow up a little bit with Mr. Grewal, because obviously a shortage of skilled people, can have a bit of a drag on projects and business moving forward. But as important it is to have people, and whether it be intellectual property or whatnot, you also need to have capital. And we've seen in the past few years in this country a precipitous drop in investment in Canada. Could you maybe just start us off? Where are we right now as far as business investment? I'd like to find out a little bit more as to where is this simply business investment that is replacing old equipment or maintaining current capacity rather than expanding capacity?
In our current report, our view would be that going ahead right now, capacity is relatively high, historically speaking, just for the goods producing sector. I believe it's around 85% of their estimated capacity. So going ahead, we think that firms, a lot of the investment that they're going to be undertaking isn't just to replace old, it's actually adding to the capital stock. And in our outlook, that provides a key driver to expanding the capacity for the economy and increasing potential output.
Can you say where most of this is? Again, you're speaking in aggregate, so it's spread over the whole country, but we obviously know that certain regions are experiencing probably some ups and some are facing down. Could you maybe clarify where you see some of this productive capacity going?
I'm sorry, but I can't speak to sort of the outlook on a regional basis. We prepare our projections at the national level, unfortunately, but we do see it broadly across the components of business investment. So we see the increase in investment levels in machinery and equipment. We also see it in the non-residential sector and mining and engineering structures, as well as investment in intellectual property and products. So it's very broad-based across those sectors, and the extent to which those sectors would be located across the country, that's where we would think that would probably be fairly broad-based.
Though you say one of the downside risk factors is business investment. Maybe if you can clarify that, because it sounds to me you're painting a slightly different picture than the risk projection.
Just before Chris answers your question, you asked a specific question. For those of you who are interested by what's going on in Montreal in terms of artificial intelligence, it's quite impressive because you have both immigration and capital investment in something totally new. So for your example, if you were looking for an example, I mean, Montreal is now considered one of the world center for artificial intelligence. Why? Stability, whatever, I mean, the reasons are, but this is a new example of something totally new. It's not in something in these kind of investment were not known in Canada before.
Yeah, again, I think it's too early to be saying what that's going to do. As you said earlier, whether or not these innovations actually have, Tyler Cowen in his book, The Great Stagnation, points out that many improvements in IT, such as Twitter and Facebook or whatnot, actually maybe negative draws on productivity. So I appreciate that. Mr. Metier, you were going to continue?
Sure. We flag it as a downside risk, and that's because our baseline for business investment is a very robust increase in its growth rate and its contribution to the Canadian economy. Over 2018 and 2019, we have business investment contributing almost a full percentage point of GDP or to GDP growth. So it's very high, especially relative to the past few years. So underlying that, what we see is that an economy that is operating above its potential, so firms really need to expand their capacity to produce. At the same time, we've seen high levels of business confidence and business sentiment, so and relatively low, at least historically low interest rates still. So the financial condition, everything seems to be in place for this takeoff, and our baseline is that it is going to advance that way. So again, we've been disappointed in the past, and that's why we flag this as a downside risk to that baseline.
Okay, just about 9 months ago, though, there was a number of reports about business investments being at all-time low since 1981. And so is it because there was a hard contraction that now we're starting to see some growth? Again, because when you actually contract an economy and then start to see some green shoots, they have a much larger, people have a much larger view of it. But is this regaining ground, or is this actually increased capacity?
Nope. In our view, it would be adding to capacity. Some of it would be making up for that lost that rebound, but also a large part of it would be adding to the capital stock of the economy going ahead.
And as the budget officer said, that there are some new shoots as well, new AI technology and whatnot. Okay.
And I would just add that we have been pleasantly surprised on the upside on business investment in the last few quarters. So again, it could be green shoots and too early, and that's why we flagged it as a downside risk.
Okay. How much time do I have?
Another question. You got a minute and 10 seconds.
So again, a question I did ask the Governor of the Bank of Canada was if you see what's happening in the United States, stock market going up, you see a lot of investment pouring in, higher bond yields, all those things. So, how do we look at the investment that the Americans are drawing in vis-a-vis Canada? Does Canada, in your opinion, still look like a good place to invest? Or are we, I know we benefit from being a small open economy just north of the Americans, but they are also competitors. So do you have any views?
Whether we are going to pull as much investment as the Americans, that's very, very hard to say. I mean, that depends on many, many different factors.
Then would we be seen as being a good
certainly,
place?
I mean, as Chris mentioned, we have been pleasantly surprised by the rise in investment in Canada in the past few quarters, and hopefully that will continue. But again, these kind of things depend on many, many different factors, and global factors is definitely one of them. But typically, I mean, also if the U.S. actually grows faster and the economy in the U.S. becomes more prosperous, it always has some positive benefits for Canada, both on the investment side and other parts of the economy. So I mean, that's as much as I can say about this without really actually working the numbers, which we haven't really done.
Ways.
Yeah.
Okay. Thank you.
You okay with that?
Yeah. That's good.
Okay, Ms. O'Connell.
Thank you, Mr. Chair. Thank you all for being here. I want to talk actually about your fiscal sustainability report that was released in October as well. So in it, you talk about a number of things, but one of the key points is you talk about the federal government and the current federal fiscal policy is sustainable over the long term, and actually the PBO estimates that the federal government could implement permanent tax reductions or spending increases amounting to 1.2% of the GDP while still maintaining fiscal sustainability. What are some of the factors that have led you to come to that conclusion in terms of the long-term sustainability?
Well, we do this exercise every year just to show what happens in the long run if the current fiscal structure is maintained over a very long period of time, 75 years, and we sort of impose on that the demographic projections that essentially shows the aging of population in Canada, both for as a country as a whole and also for different provinces. And that exercise essentially looks at this fiscal structure and then moves that forward for 75 years and see what happens to debt and debt as a share of GDP. And that's how we calculate this number of 1.2%, that over time, the current fiscal structure in Canada at the federal level is such that you are going to have this fiscal room of 1.2%, which means that the debt to GDP ratio based on the current projection that we have done over a long period of time it continues to decline. Now, in order to maintain that as a current level, then you can still spend more money, as we mentioned, 1.2% of GDP, or reduce taxes by that amount. And what that does is that maintain the current debt to GDP ratio at that level for 75 years. Now, if you don't do that and you leave the current structure unchanged, then the debt to GDP ratio will continue to decline. And as we show in our report, the debt eventually will be eliminated.
Thank you. And when going through this report, then you do go on to look at the fiscal health of the provinces and territories as well. And in a lot of those instances, the fiscal sustainability is not so good. And so I guess my question is in and around what happens if, for example, in certain province or territory where a lot of it is aging demographics, especially in Atlantic provinces, What happens if, that fiscal sustainability is not there, and that either means the federal government steps in or there's risks, even if the federal government isn't directly impacted through injections of money, essentially, then the tax base that is contributing to the overall federal situation would be impacted. Have you built into your more, I guess, macro models those types of risks that we're seeing provincially on fiscal policies?
Well, what this study does is it provides a scenario that, if you maintain the current fiscal structure for those provinces that are not sustainable, then you're going to see that increase in debt ratio over time, in some cases significantly. Now, again, this is a scenario. It doesn't necessarily, it's not going to happen, because if you get to that point where the government see that is going to happen, they will have to do something about that. So those things could be something that internally that the province would do in terms of their spending or taxes or revenues, or it could become, some of it could come, some help could come from the federal government. But there are different sources. As I said, those provinces can raise their revenues potential, or they can reduce their spending, a combination of those two, or they can convince the federal government to provide more transfers to them to help them out. But these are all sort of different possibilities for them. The idea is not that we are going to actually see those crises or those debt levels or debt ratio levels. It's just that what the study shows is that there is a challenge for those provinces, and they have to think about solutions for those now or over the next few years to sort of prevent that from happening over time.
Thank you. And I have time? Thanks. And this might seem like somewhat of a silly question, but I find it interesting that we're looking at our debt to GDP ratio. That's the measure we always use. Canada's in a very good position, especially compared to other countries. But then when you talk to the average Canadian or a regular person in terms of that scenario, and it's really hard to kind of to explain what that means and why Canada is seen as in a very good position on that measurable. So my somewhat silly question is the fact of, how would you explain, or how do you really talk about the fact that the debt to GDP ratio and what that means for the average Canadian, in the sense of most Canadians look at debt as something you want to pay off, like that is your goal, to pay it off, and as governments go, that's ultimately the goal as well, except being in this low debt to GDP ratio is really a good scenario, and why Canadian, I guess the simplified way of how we explain this to Canadians in terms of Canada's current position and why it is seen to be in such a good ratio, and why this ratio is seen as a positive kind of element. So I ask that question, and I say it might be silly in the sense that we talk about it very clearly here, but then I find when I go back to the riding and you say that statistic, and it's like, well, what does that really mean?
I think part of that reaction stems from the linkage between a household budget constraint and the government's budget constraint, and really there isn't a linkage. And unlike households, the government doesn't have to repay ultimately its debt. And so the way I try to think about it, or would explain it, is that what you really want to think about is the debt burden. And the debt burden, the most commonly used measure, is the debt relative to the economy. And what typically governments wouldn't necessarily want to do is to undertake fiscal policies such that that burden would be substantially increased for future generations. So the idea of keeping a stable debt to GDP ratio is, you can think of as basically not passing on an increased debt burden. And it's important to think about it in a ratio, because in the future, incomes of those generations, they'll be a lot higher than they are today. Their ability to service them should be commensurate to what the burden is faced on current taxpayers. So I think you really, maybe unfortunately, some economists have linked the balanced budget or debt elimination as the sort of the best indicator of sound financial management, when I think the sort of a much better one, and is most commonly used by budget offices and I would say most economists, is the debt to GDP ratio.
Thank you.
Okay, thank you all. Turning to Mr. Kelly.
And I do just also, for the record, Mr. Chair, want to comment on Mr. Greywall had earlier said that in commenting on the debt to GDP ratio being projected perhaps to drop to 29 versus 31%. He characterized that as a commitment that they had made, and I do want to remind the committee that the commitment that was made in the election campaign was not a 31% debt to GDP ratio. It was in fact to run a maximum $10 billion deficit with a return to surplus by 2019. Having said that, I'd maybe go to the questions and pick up perhaps on a theme arising from a response to the very first questions that my colleague Mr. Sorbera raised, and this was with regard to the negative impact on the housing market and on Canadian households when interest rates rise as they are expected to do so. We have heard throughout in this panel and in the earlier one about just how difficult it is to forecast the future, and all of the different factors. We've heard repeatedly that there are an infinite number of variables that are very hard to know for certain what is ahead of us. So how much risk is there to the projections of a reduced debt to GDP ratio, and indeed to continued and increased deficits that are ultimately, as my colleague Mr. Poilievre pointed out, borne by Canadian households through taxes? What are the risks of these projections not being made if for example, there was even a slightly larger rise in interest rates than what you have already included in your projections?
Thank you for the question. We've tried to quantify this risk in our last two reports, and in Figure 7 we provide an estimate of the probability that the debt to GDP ratio would be above its target in 2021, so that 31% target, and it would be about a 25% chance. Now that's based on the assumption that we're basically as accurate going forward as, let's say, on average, private sector forecasters have been in the past. So if we miss on interest rates and growth rates, this is what, all else equal, no policy changes, this is what we would expect as that amount of risk.
Any of a number of factors could throw this off, including a failure to predict a significant downturn in the global economy, something that very few forecasters ever predict accurately.
That's true, and our estimate would reflect sort of to the extent that in history we've missed those downturns. We've built that into our projection going forward, or our estimate of the probability going forward. So it would be the same if we were as bad sort of over history. If we continue to be as bad forecasters as we were over the past, it would still be roughly 25% of the time that we would miss this debt to GDP target.
Okay, I'm not sure how much reassurance that was intended to convey, but I guess all of this uncertainty is part of why many commentators and many people would say it is so unwise to run large deficits during non-recessionary times. And this is if there is to be, I mean, if you could run a surplus, if you were in an expanding economy and times are relatively speaking at least not recessionary, ought the government not to run a balanced budget as promised, or at least try to come as close as they can, so that if there is an unforeseen downturn, that there is fiscal capacity to deal with it?
I'm not going to comment on what the government's fiscal target or policy should be with respect to having a balanced budget or not. That is a political choice. But economically speaking, there's nothing requiring a government to run a balanced budget year after year or only in certain periods. If in our longer-term framework, what we've tried to stress is that it is sort of typical, or at least according to conventional economics, it's the debt to GDP ratio. So even with a relatively stable deficit debt to GDP ratio, that would mean or imply or be consistent with relatively small budgetary deficits on balance over the cycle. And the sort of the shock absorber, to respond to your question about, well, what would happen in the event of a severe downside shock? Well, that's simply the case where the government would have to go and borrow and absorb part of that shock. Now, again, if it's a very extreme financial market shock where the government couldn't go and issue debt, that is a very extreme tail scenario. But in all other cases of relatively slower growth or weaker oil prices or something, that probably would be absorbed with just issuing more debt, running larger deficits temporarily.
Mr. Fergus.
Monsieur le Président.
Thank you very much, Chair, and thank you, Mr. Fréchette. I must say, the work that you do is always very stringent, very precise, and I particularly appreciate the work that has been done by your office of the PBO before I became a member of Parliament, and now as a member of Parliament, I appreciate it even more. I would like to come back to this question with respect to the economic and fiscal outlook. Number 6, my colleague Mr. Dussault spoke to it earlier, and I would like to ask a few additional questions. Well, with respect to your 70% figure of confidence, I know that it is not totally specific, but we can foresee a possibility of running a deficit of some $30 billion towards the end of 2021-2022, where you might see a surplus budget of some $10 billion. Can you give me some clarification here? Can you explain what conditions would exist that would allow for the worst-case scenario, and also what conditions should exist for the best-case scenario?
With me, but I can follow up on what the growth, real GDP growth and nominal GDP growth, as well as what interest rates would be. But typically in those outer years, you would see, I think, in terms of nominal GDP, our 70% confidence interval is a plus or minus a full percentage point, or 1.1 percentage points nominal GDP. On interest rates, I don't recall what the range would be, but essentially in those tail, or at least in those intervals, you would see, low growth, high interest rates, high growth, low interest rates in those ones. But I can follow up with the exact range for the interest rates.
Yes, but perhaps I can ask you something more specific. when you talk about the rate of the Bank of Canada, that is the key interest rate. It is that policy rate is much lower. Why is there a possibility or even a probability that the policy rate of the Bank of Canada would be at that level? We haven't seen it for a long time.
3% level that we have assumed in our base case is consistent with the Bank of Canada's estimate of what it thinks its policy rate should be when inflation is at its target, when the economy is at its potential capacity, and when there aren't any temporary shocks. So in putting this together, what essentially we've done as we've looked at the Bank of Canada's monetary policy report and looked at current levels of interest rates, and we know, according to the bank, that inflation will be at its target in, I think, the second half or the first half of 2018. The economy will essentially be at its productive capacity or potential output, and the bank, I don't think, has flagged any temporary shocks. So implicitly underlying the Bank of Canada's forecast, our conclusion is that interest rates are going back up to 3%. So they're the ones that set the policy rate, and if they assume their judgment is 3% is the right number, we're going to take them at their word, and that's in our forecast. Now, of course, there will be shocks going ahead, and some of our underlying assumptions won't pan out, and interest rates could be higher or lower than what we're projecting on our way to 3% or its neutral rate. It would obviously be helpful if the Bank of Canada published its policy rate path going forward, but I think you can read between the lines, and it's clearly indicated in the report that 3% is what they believe is consistent when inflation's at its target and the economy is at its productive capacity or potential output.
Encore une fois, si je veux pas.
I don't want to question the bases of the Bank of Canada's position, but I'm very optimistic, of course, but it seems that since we bought them out in 2008, it's been 9 years. And since that time, the policy rate plunged at the outset, stayed flat for quite a long period of time. We've seen a very small increase this year. And now it's being recognized that because of the situation, that is to say the indebtedness of Canadians or digitization or a type of excess capacity, slack in the economy. Over the short term, we can see that the policy rate will continue to more or less stay at a low level. Certainly, I'd like to see a rate of economic growth that would certainly take off to 3%. But I would imagine that once again, they are relying on data that have been supplied to Canadians through the aegis of the Bank of Canada. But you, as economists, it certainly doesn't give that. It does not give you some pause for thought that a rise to 3%?
It's right. You're correct that we're going back to 3% as our estimate of the neutral rate. The one point I would make is that this estimate of the neutral rate has been revised down significantly just over the period where that you mentioned in terms of the following the global financial crisis, where I believe that the Bank of Canada previously had estimated that rate around between, I think, 4.75 and 4.5. So there's already been that a very large reduction. So we're not going back to levels that I think we're used to seeing. 3 does seem like a big increase when you're at 1. But in the Bank of Canada's framework, they see inflation coming back. They see the excess capacity of the economy tapering out. And so those conditions are consistent with 3%, a 3% policy rate.
Okay. Before I go to Dussault, Mr. Dussault, I got a couple of questions, then Mr. Picard, and then back here. Just on your EI section, Table 7, next year you're anticipating the benefits to go up by $1 billion. What do you base that estimate on?
So our benefits projection is mostly a function of our forecast of the rate of unemployment and eligibility. So if program rules change so that unemployed persons are now subject to for benefits where they might not have been in the past, that's going to increase the ratio of EI beneficiaries relative to the number of unemployed. And I'll also highlight that the government, as part of Budget 2017 and even in the interim between Budget 2017 and the last update, there were a number of changes, temporary changes to the EI program that increased the ratio of beneficiaries to the unemployed. And this helps explain some of the increase in our EI benefits forecast over the medium term.
And the premium rate at $1.88, $1.63, I guess now. How's that compare going back? It seems to me it was considerably higher.
Yes, so just off the top of my mind, the EI premium rate was higher than $1.88 in the past. I know that in prior years it had been in excess of $2, but I could get you the historic series. But
we can probably find it anyway. On your Table 6, children benefits, does that include the economic update, the increase in the, okay?
Yeah.
And Table 5, where does the small business tax fit in your chart in that table? Is it under the corporate income tax?
Corporate income tax, yes.
And that includes the economic update going out?
Yeah, exactly.
So if I look at 2016, 2017 versus 2022, 2023, and I'm comparing, I'm one who feels that personal income tax is too high and corporate income tax is too low. Just tell you where I stand. In this year, corporations are paying 22.7% as much tax into the system as the personal income tax is. In 5 years out, the corporate income tax is going to go up a little bit from 22.7% of the share to 26.3%. Do you know why that is?
So a major reason why our corporate income tax profile is, let's say, flatter as a share of GDP as compared to personal income tax has to do with the fact that over recent years, now the proxy that we use for the corporate income tax base is corporate profits before tax in the system of national accounts. And this has been very, very weak throughout the past 2 or 3 years. Now, in what's somewhat of a puzzle, the taxable income base, as we see on CRA T2 forms, has held very, very strong. And commensurate with that, corporate income tax revenues have been very strong as well. Now, given that there's been a lot of, or very low profitability in recent years, we think that this is going to lead to, let's say, greater loss carry forwards in subsequent years, which has led to us having a slightly weaker CIT, corporate income tax revenue profile, over the next, let's say, 2 or 3 years of our forecast.
Okay. I guess one other quick question. How do we compare with the rest of the world, or do you have those figures in terms of what business tax are versus personal tax as percentages?
I don't know off the top of my head, but it's certainly data I can get for you.
Okay, if you can get that, great. Mr. Dussault.
Merci.
Thank you. I just want to reiterate what was said. Yes, your request to have that data, because that's very important. When we look at the figures, I'm sure we'll be able to see what the ratio is, that it's moving more towards private citizens than towards businesses. I'm looking at Table 7 and the seniors benefit linked to the changing demographics. What problems do you see as to how we're going to live in the future? I mean, it was 48.2 billion and now is moving to 66.9 in the coming years. That will have a considerable influence. What is your perspective about that? Do you see any possible future problems for Canada given this type of increase? And in view of the fact that the rise in the seniors' allocation will change, and also what is the place of this allocation in the context of the government's overall budget? Do you foresee problems in the future?
It's a really good question because I think it ties naturally with our fiscal sustainability report, where we do look out over the long term, so we're able to see what, with population aging and the OAS and elderly benefits program, what are the impacts? And we do project a sizable increase in those relative to the size of the economy out to, I think, 2032 or so is its peak. One of the sort of compensating factors is that these payments to seniors are indexed only to inflation. So over time, yes, there is this as the baby boom cohort goes through and collects OAS benefits, as they depart, there'll be less pressure, at least relative to the size of the economy. And unlike, let's say, healthcare spending at the provincial level, where basically spending is growing at the rate of the economy plus the aging that's going on, the federal government doesn't face this pressure, and actually, once beyond 2032, we'll have more fiscal room.
Merci. Monsieur.
Thank you. Mr. Mathieu, in your remarks on the servicing the debt, you talked about the percentages that represented rather, and that if that continued to rise, we could be facing a tax crisis, a fiscal crisis. If you take a look at this type of crisis, servicing the debt may put this country in a precarious situation.
I don't think I said that, or I didn't mean to say that the federal government was facing a fiscal crisis because of rising debt charges going ahead. If anything, we think even though we are projecting an increase in the level of public debt charges, these are manageable within the government's current fiscal policy if the sort of the measure, the benchmark is maintaining a debt to GDP ratio on a downward path. So it's still it's not a crisis per se.
What I wanted to say is that it's not because we're going to face a crisis, that the percentage that we were looking at, the height of this percentage seems to be similar to the one we got years ago when we faced, at the time, a financial crisis. So therefore, at the time, the country must have been in a more delicate situation than obviously the one we're looking at, considering that there seems to be some positive trends to inflation, productivities, and revenue in general.
I think the one important distinction that you really have to make relative to that period is that yes, debt charges were high, but our debt to GDP ratio was also at its peak, at least according to Finance's fiscal reference tables. I think around that time, the peak of the debt to GDP ratio was about 67%. Right now, it's, I believe, 30, so it's less than half of that. And now, in comparison to those previous fiscal crisis period, public debt charges are really only around 8 cents per revenue dollar, whereas previously they were as high as, I think, 30 cents of every revenue dollar went to debt charges. So even though the level of debt charges might be comparable to that period, the broader context of the government's federal debt relative to the size of the economy and debt charges relative to revenue are very, very different.
So therefore, very encouraging.
Thank you. We'll leave it there. I've got a split question over here, Mr. Albas, Mr. Poilievre, and that's it. We're a little over time.
Sure. Thank you, Mr. Chair. Again, just in reference to last week's economic update, quoted about $18.4 billion deficit projected for this year. Your numbers are saying it's higher than 20. Why the difference? And I have a very short question after that.
Yeah, so for this 2017-18 fiscal year, I think the major view in difference between ourselves and finance was our view on corporate income tax. So we think that corporate income tax revenues will be lower than the view of finance as part of the fall update, and that explains much of the difference between our views on the budget balance.
Okay, if you could expand on the reason for that, but also my question is, there is, in previous years, there's been a contingency fund. Now it's called a risk fund or whatnot. The name keeps changing. Can you maybe comment on the nature of that, whether it is helpful public policy to have a constantly renamed fund, and whether it's appropriate for the Minister of Finance to cancel something one year and then bring it back under a new name the next year? In terms of profiling.
Your question now, and I can answer them both at once. We're over time.
Well, the contingency funds actually, or whatever prudence factor, or you're right, the name has changed over the years, over many years. There have been different definitions of this, but the bottom line is that that's just to protect against any kind of a downside risk for the economy and possible changes in the global economy or fiscal structure. So that's just a cushion that the governments provide for themselves for unforeseen events over time. Now, for this update, there was $1.5 billion for 2017-18, and then $3 billion for the rest of the projection period. And the difference between our bottom line fiscal balance projection and the finance department is essentially that, because we do not include a prudence factor in our projection, whereas they do. And on average, that really explains the difference between the two projections.
Okay, last quick question.
Chairman was asking about the relative share of the tax burden on corporations versus individuals. We have in this country the system of tax integration where companies pay the same tax on corporate profits as individuals pay on income when the tax on dividends is included. And when corporate taxes go down, the tax on dividends automatically goes up. Is that correct?
Yes, that's correct.
So the question I have then is, ought we, all of us, Finance Canada, PBO, and everyone else, not include the dividend tax that is paid on corporate profits flowed to shareholders? Should that not be included when we calculate the share of the tax burden paid by companies as compared to the share paid by individuals?
So, my understanding of this is that dividends are a form of income to an individual, much like labor income would be, and that ultimately the owners of all corporate income are individuals themselves. So income's either taxed at the personal level or at the corporate level, and it's the desire, I think, of the Canadian tax system to ultimately have some harmony between those two systems. The relative split between those two, I don't think is the role of our office to comment on that.
Is there a place where those figures are accessible?
So
because it would give a more fair comparison.
The OECD, IMF, these international bodies have comparable statistics on taxation, and I'll send the committee this data.
Okay. Thank you very much to Parliamentary Budget Office and the 4 witnesses. Meeting adjourned.